How do you sort of figure out when do you rebalance your portfolio? How do you rebalance your portfolio?
This, turmoil time is a great time to think about rebalancing. Things are changing. Donald Trump is saying, maybe I will reduce my tariff and maybe I won't.
Courage is an important quality. Most people don't have that. So it's a fine line between risk management and courage. You're in the stock market to make money. You're not there to save money.
A lot of people who've gone through these market crash, they don't know the concept of having that emergency fund, right? So our goal is that through fixed deposit and through bonds, retail investors have their emergency fund, which covers for all the worst situations.
What are the mistakes that you should not make while getting into equities?
There's a Larry Hite saying, if you don't bet, you can't win. And if you lose all your chips, you can't bet.
There you go.
You start building your emergency fund and keep moving upwards of your risk laddering very quickly and see what suits you and keep moving.
One should be weighted mostly towards equities, especially if they're younger. The younger, the better, because you have less money, so you will lose little if you're not good at it.
If I have financial independence, I'll be able to do a good job what I really want. That is more critical than this whole retire early piece and putting a number to it. 10 crores in India is that number or whatever.
What is your favorite part of what new age investec firms have to offer?
When you see that these class barriers eliminated, I think that is just fascinating. A Swiggy rider today can actually buy a share of Swiggy. Domestic consumption, I think we are under indexed on that. There are not enough bowling alleys in India to meet all the bowling alley requirements. And I think domestic consumption is a huge thing that is going to happen to us.
We have lots of pickleball and paddleball courses.
Apparently, that's the new thing that's being invested.
We're into a new financial year, but there are a lot of things around finance and the economy that seem to be on shaky wicket. The Indian capital markets, of course, have been hugely volatile and been in correction mode for the past 6 months. We've seen retail investors getting jittery. And of course, to trump everything off, literally, we've got the Trump tariffs dragging down the global economy. And of course, what happens to India's growth story and GDP. What will hit home the hardest is the state of our personal finances and investments. We'll also, though, take stock of what has happened in the past 5 years in India in terms of a spike in Demat accounts, currently to the tune of 21 crores, with 11 crore unique Demat account holders. Mutual fund SIPs have also soared on the back of new equity investors entering the markets thanks to improved access, information and technology led by Investec and Fintech startups, benefiting retail investors. But how is all of that evolving now? What do we do given the current market volatility? How do you really play out the two key sentiments of market cycles of fear and greed? How do you rebalance your portfolio? And what are the practical steps that we should take in the near term? We will deep dive into all of that. And our first question, of course, no prizes for guessing, given the current market volatility and what we've seen ensuing in the past 6 months, Deepak. How do you really read it? Because, before all these Trump tariff wars also came about, we've seen a correction for the past 6 months.
I think we've got this 6 months of uncertainty. Part of it was, the shake-up perhaps globally in terms of, initially it was about India not being affected so much by worldwide volatility. And eventually, India did get impacted by worldwide volatility, and then we saw this, FIIs pull out more than 300,000 crores in 6 months. They put in a reasonable amount of money in debt, so the fixed income yields and markets have done well, but the equity markets have been, hurt badly. And I think to that extent, while domestic investors have kind of tried to replace it by keeping their SIPs on as much as they could and so on. But the remaining whatever was not being able to compensate for it has resulted in stock prices falling. So you're seeing mid caps, small caps, the ones where liquidity is very high, fall quite a bit. I think it's scary mostly because I think we've had a bed of roses for 4 years. This is not meant to be a bed of roses. And we're just being reminded that it is not. Because in the early days of when I started, 2004 to 2007, every year saw a minimum of a 20% fall. Most years had a 30% fall, and the market went up 3x. So while we saw the market going up, every year was such a reminder that markets can be volatile that you didn't expect that markets would be stable. And I think right now we're seeing we're seeing this kind of come back to hit us, and it's not bad. We're just only about 20% from the top. So meaningfully speaking, it's just a lesson of what can be, but not really what has been.
Sure. So you're not really calling it a bear market yet, but how alarming is the situation in terms of, now the Trump tariffs also playing out? There is, of course, there are many reports saying that the GDP growth in India could see a slash of about 20 to 40 basis points.
So 20 to 40 basis points for our economy, just to give you an idea, is roughly 50 basis points for our economy is probably about 160,000 crores, 170,000. Just the tax cut which is effectively here, which is of 1 lakh crores direct and probably 3 lakhs crores indirect, because you have employment and all that, will offset any of these Trump tariff things that we're talking about on a direct basis. So I don't think that 0.5 or 0.4% of GDP is meaningful from that perspective. And it will also spur domestic business activity. It will build more capacity locally on the domestic consumption front. So I don't think this is such a big deal in the long term. But in the short term, there is a lot of drama. And when there's a lot of drama, the markets react more, violently. And it's the nature of markets. Markets are like sugar given to a baby. The baby will spend a lot of energy very, very quickly and appear like both crying and laughing at the same time. That's how markets are. And then at some point in time, you kind of find out that the reality is more sober in nature, and then things go. But it takes some time. So we're in that time. You're in the time when getting beaten up every day. It takes a certain, unfortunately, I call it the uncle temperament. You have to kind of be a uncle, kind of a calm person, just to ensure that you live through this, because it always seems like the end of the world in markets, but it never is. You need to live through the volatility in order to get to the other side.
So we're seeing this is normal, but when you look at the markets, like you said, we're fighting at daily basis, we will find that level. Tejas, are you looking at, this rise in volatility that we've seen? Is it irrational panic on the street? Should traders be obsessed with levels at this point in time? How are you looking at it?
Traders are always obsessed with levels. Goes without saying. They're always obsessed with levels regardless of how calm the market is also.
Yeah.
And currently, I believe everyone is in chaos, right? Like nobody really knows for sure.
Yeah.
Some people think that the whole Trump thing is an unknown. Some people think it's a known unknown. But there is an element of unknown in it. When money is on the line and it's moving every second, one is prone to react emotionally. So yeah, it's part of the game.
Is it worrisome to see this market correction undoing a lot of the good financial investment behavior that we saw? Because a large percentage of retail investors had actually warmed up to mutual funds, right?
Yeah.
Post-COVID, and that number had doubled since March 2020.
Yeah. So what we have seen, maybe last 10 to 12 months, around 80 lakh to 1 crore people have got into the mutual fund. And generally the trend that we have seen, at least in the last 4 or 5 years, is anytime you put in money, the money grows, right? That has been the market trend. And at those points, everybody thinks that they have been a smart investor. When such things happen, I think it gives some reality check to the investor, saying that no, it won't be like the bed of roses at all point in time. This is where the retail investor goes back and thinks about how should be the portfolio allocation, where all you need to invest, how much you need to do. And there is a lot of awareness that also happens, right? This fall that we are seeing right now will be spoken few years down the line, saying that, this time these many people have continued their SIPs and this is how their returns are now looking like. So this is all learning phases for all the investors who are seeing this as the first time.
Right. So in terms of a realistic picture as well, Deepak, are you seeing a lot of SIP breakages? Are you going to see more of that happening? And when you look at the returns as well, that really is what also causes panic, right? Like, what should these retail investors really assess before they cancel their SIPs?
There's an interesting point. There is always, if you look at the history, whenever market returns have fallen negative on a 1-year basis, there's been some kind of a retail pullback or I don't want to invest kind of a thing.
Right.
But I have not seen a market like this, where regardless of returns falling to sub-FD levels, people are still putting in 35-40,000 crores a month. I mean, it is ridiculous that we are seeing small cap funds, which are affected 35%, getting net inflows month on month, January, February, March.
Oh, you still saw inflows.
And let's not forget, this is despite S. Narayan and the other veterans from the industry who come and say things like, one needs to moderate small cap exposures, but nothing seems to be having an effect.
This is like, it's like a force I have not seen. And I can tell you this, it's because people have the money to save.
Okay.
So there was a time in the US, and there were two specific times. One was the 1960s and one was the 1990s. When people just shifted their income levels beyond a certain point. The 60s were insane in the US. This is when Warren Buffett made his first massive pool of money as a partnership. And this is when retail investors started putting money into mutual funds. In the 90s, they started putting money into ETFs. Again, the end of the 90s saw a massive shift. There was a book which talked about $2 billion a month coming from retail investors into the stock market from 1998 to 2000.
This is in the US.
This is in the US. So the force of that money did not stop for too long. It took the Dotcom crisis, it took 9/11 and two scams, Enron and there was another one, like WorldCom, to like slow down this juggernaut, and then they continued afterwards till 2007. In 2008 things changed.
Yeah.
But when you have retail investors of this magnitude putting in money, who don't necessarily seem to be caring about the outcome just yet. And this is strange because I have not seen this. I've seen people jump out. It's mostly, why do FIIs own most of our non-promoter holdings? Was that retail investors would sell and panic. This time, it's the FIIs that seem to be panicking and the retail investors that seem to be buying. 10 years ago, if you take out the promoter holdings, half of the remaining was owned by foreign institutions. And the remaining half by mutual funds plus retail. Today, they own about 1/3 of the remaining, and that's foreign investors. And just domestic plus mutual funds own a significant percentage more than the foreign investors. So more of India is being owned by Indians. And they're continuing to buy.
But this could be scary as well, right? Because retail investors are putting in money without having full context of what is happening, with just the hope of 5-10 years it will be.
The thing is, I think they've believed the big narrative, right, that of long-term investing, and that MF is sahi hai, and then wealth is created over the long term, like on a decade, 2-decade period. I think that is something that they genuinely believe. And so all of these political developments, geopolitical risks, as we now see, are almost viewed as some small fluctuations in the larger scheme of things.
Yeah, that's
India
great
will
that
always
people,
shine out.
Because
the
ultimately
India story is holding up.
India's story is holding, but whether or not it's holding up, at the end of the day, that's what they think. They think that we're heading towards a Viksit Bharat, right? And so something like this, if let's say the confidence came from COVID, the way they bought COVID, this in comparison is small because nobody really, like the retail investors don't understand the impact of Trump tariffs and how it's going to hit the global economy, India GDP and all of that, right? So they've already, I think, looked past it.
That's an interesting perspective. So are we saying that, now our markets were largely, led by FII investments and the influx of that. Now we are able to hold our own in terms of DIIs and retail investors, and it's become broader and deeper thanks to them.
If you take 30,000 crores a month,
30,000 crores is a reference to the inflows.
Inflows into mutual funds alone. This means roughly 400,000 crores comes into Indian equities on a yearly basis. If you add up all the IPOs, add up all the new issuances of stock by companies raising money and all of that stuff, it's about 250,000 crores last year. So if you have new stock of 250,000 crores, but people that want to buy it of 400,000 crores, just new money, you're going to have prices go to an extreme anyways. And maybe that's also what's exciting people, saying, oh, prices only go up. And suddenly this is this rude shock saying, oh my God, because this 250,000, 400,000 equation worked when the FIIs were neutral. But when the FIIs were selling, they were taking out this liquidity as well. And you couldn't meet it. And so now you can see IPOs get cancelled. Companies doing less mergers and acquisitions because there's more uncertainty. Perhaps the inflows will moderate at some point. But I'm telling you this, I think that I need the data to reflect it, because even days like when there's a 4% fall in the market, the question isn't, are people selling? The questions we're getting is, can we start buying?
Yeah.
It is the exact opposite question what I'm used to most of the time. I thought we'll have to write a letter saying, don't sell. But I'm writing a letter saying, don't buy so fast just yet.
And I think you've also said that we need to temper our expectations of 15-20% returns from equity. So are we seeing then, Saurabh, more interest towards fixed income products now, say fixed deposits, modernized versions of fixed deposits, if you can take us through that, as well as bonds? Is it a good time also to lock in good interest rates when it comes to FDs? Because, we know RBI's stance, we've seen a rate cut last month, and that could, more of it could happen. So is it a good time now to look at fixed income?
No, it's been always a good time. Like, for example, fixed deposits is the most favorite asset class. It has passed the test of time last so many decades. It's been there, and still you have 25 crore FDs there, almost 18-20 crore retail investor investing is significantly higher than what the equity mutual fund investors have been doing. Almost 65-70 lakh crores sitting in fixed deposit, and it's growing year on year even at that scale, because there is a specific use case that it serves the retail investor. A large part of India so far, and still a large part of India, believes in earning more money than growing your money through investments. Right? A lot of us today have been talking about stock markets, stocks, and a lot of these things, but a large part of India still focuses on how do I earn more, open more shops, focus more on business, getting better jobs, getting better education, all of that, right? Where the capital is more about conservation. I want to have that as a cushion in worst times, and that's been the fixed deposit story so far. And there is no downturn, misses, issues that fortunately regulators and everything ensure that this asset class stays put always. That's where I think this has become a very interesting story. Last 4 or 5 years, this whole mutual fund Sahi Hai story has took over. And that's where we realized there is a big opportunity, because a large segment of India is not getting into the capital markets. The rate of growth is still slower than what we had seen initially. And the major reason is this is not the comfort zone that they have, right? A lot of investors we have seen dropping off the stock markets, mutual fund, as soon as they see negative returns, because they don't know what to do, right? So we believe that the great way to do that is digitize, improvise the way they are doing fixed deposits. That's what we are doing. Get them to try technologically doing a fixed deposit rather than doing it very traditionally, and then slowly move upward. That will be the right way to move these remaining 10-12 crore retail investors to get into the capital markets, right? So that's the story. And talking about now, we believe that with the repo rates, all of these now falling, this is a great time to lock in for the higher interest rate for the fixed deposit, 3 to 5 years before you get to another 5 to 6% FD rates.
Okay, so thanks for setting the context there. We'll delve deeper into fixed income. You mentioned about, people selling their mutual fund NAVs when a typical situation like this happens, a huge correction in the markets. We've seen 20 to 30% drawdowns, right, Deepak? So how should, the younger crowd, the people who got into investments during the COVID era, do they sort of sell their investments and sit on it? Do they look at fixed income? What sort of behavior trends are you noticing?
So I think this is one of those great times for those, the very boring words called asset allocation. So you were 100% equity, got whacked. And it's like you go into a football game unprepared, you get beaten minus 15 to 0. And then you come back and say, boss, I need better players on my field, putting only forwards in a game which needs defense and a bunch of things, right? So you're going to go back and say, well, you know what? I need a little bit of fixed income. I need either FDs, or I need bonds, or I need products which protect me from volatility. I need this equity thing. I need this gold thing, because these gold flows are going up also. So if I give a bit of everything on my plate, I'll be able to write out the next thing. The great thing is these people haven't taken bank loans to go and buy equity for the most part. So they're not getting wiped out. So they're just getting like, oh, I can't deal with this level of volatility. This is the learning that happens to the first time investor, and there is no other way. This is like, because I can't tell people when they start off, saying put money into little fixed income. They're like, udhar 13%, yahan pe 7%. No, I'll put everything. 13, 15, 20.
I have the risk appetite.
Yes, I
I
have the
can
risk
do it.
appetite. And then this risk appetite suddenly vanishes. Like, what do you do next? You find your risk appetite. So the way you do this is you say, okay, I can deal with maybe 30% or 50% of my money in equity, the remaining in fixed deposit, fixed income. I'm happy to get some income from there. Fixed deposits, unfortunately, have been tax disadvantaged compared to fixed income mutual funds.
Yeah.
So also we don't realize that when interest rates fall, fixed deposits just lock your rates. Bonds and bond funds will make even more money. So I bought a fixed income mutual fund, which invests only in government securities, which gave only 7% yield at the time. But when the yields have fallen from 7% down to 6.5% today, that has given me a 12% annualized return, which is better than the equity in the last 1 year for sure. So you can actually get a combination of these two, equity and debt, which at some time might actually both balance out your returns, but also give you superior returns even on the fixed income side. Gold has given you phenomenal returns over the last few years. So if you have a bit, something starts performing at some other point in time, and you start. So I think this one thing is to get into this asset allocation part of things, where you kind of balance your portfolio. The second thing I think more meaningful is you don't invest for the short term. You don't invest because I need money in September, so I start investing in July in equities. So even now, people call me up and say, Deepak, can I put money for a year? And next year I'll be okay. I said, no. Because last year we weren't okay. So why are we going to be okay next year? I said, but how long? I said, 3+ years, I can tell you, maybe meaningfully, there is a more historically correct correlation between making money in absolute terms and this 3-year period. But in a 1-year period, there is a 33% chance you will be negative returns. And in a 5-year period, there's a 98% chance you'll have positive returns. So
Interesting, yeah.
you just have to stretch your horizon. But see, I can say 5 years. I'm 50. It's 10% of my life. For the person who's 20, it's like 1/4 their life. They're not thinking 25. They're thinking like, boss, next year ka kya hai? No, what is the thing? So relatively speaking, experience sometimes requires you to just live enough through the volatility to say that it will be okay through it.
Yeah. Hindsight, of course, makes a lot of sense.
Why do people invest in the stock markets? Because they're greedy to make more money, right? And the fact that so many of them in the markets, especially from the age group the working age group between, say, 23 to 38, maybe 40, why are so many of them trading derivatives? It's actually a symptom of something bigger. Derivatives having gone mainstream is a symptom of something bigger. It could be because people think short term, right? It could also mean that they have desires that their salaries cannot fulfill, maybe. The level of income is insufficient. So the general attitude towards money has changed. That's my big takeaway over the last 5 years.
Yeah.
Right? And they aren't really expecting 13% returns, even though that's what the linear returns of equity markets may have been over a longer period. The expectation is much higher than that. The derivative market is like, it can be 5-10% a day. They're thinking how to double their money as fast as they can, maybe at least in a quarter. Because we've seen an era where people have made massive amounts of money. And because of direct investing, look, there are about less than 5 crore unique mutual fund investors in India. Am I right?
There
approximately.
are 4.5.
MF folios are in the range 4.5-5 crores. There are 11 crore Demat account holders, unique Demat account holders, in total double of that, right? So there is more direct participation today than there ever was. Like we grew around 30x since COVID without much marketing.
So that's the question I want to ask you, right? Because when you take stock of what Investech and Fintech companies have enabled for the retail investors and discount broking, what are your standout features in terms of how you're adding value to them? And we are at this situation where, there are a lot of DIY portfolios as well. You also have very interesting products like small case, which a lot of millennials have taken to, which have been hugely beneficial as well. But when you look at, is there enough investment access? Is it just that, their risk-taking appetite was larger and hence they got into it? What is the kind of access that we've given to these retail investors, and, what are the pros and cons of it in terms of the information that they
Such a
have and the
profound question.
expectations?
So in 2017, we built out something very similar. It's called a thematic investing platform. That what we were trying to do was solving for the lack of a lack of retail investors' ability to do research, but the willingness to invest, right? So we created these themes, mini portfolios, through which they can invest in concentrated, sort of create their own baskets. It didn't work out because we recognized very early that investors, especially young investors, were willing and aggressive enough to take matters into their own hands. Like, they didn't want to be told what to do. They wanted to pick the stocks. They were willing to go through and do their own research and pick stocks because they were aiming for much higher returns. And that's a big part of this. The market, when I was growing up and I worked for various different financial services brokerage companies, back then everybody wanted advice. Right? After information got democratized, people think that they know as much as the fund manager. Right? So they're willing to find out on their own and invest on their own because everyone's looking at the same data. So from that perspective, the growth in DIY is explained by this attitude. They think that it's possible to put in the work in order to make more money. And many of them actually have. They've done multi-baggers in their portfolios, right? Whereas the mutual fund guy will make like 15, 20, 30% in a good bull market. Many retail investors have doubled, tripled because they went and bought all these small cap stocks, which the professional fund manager wasn't willing to because of the institutional ways of managing funds.
But is
they
that
don't have the liberty
backfiring
to do
today?
that.
Is that backfiring, or they're holding on?
Not, I mean, so some people who are concentrated in some really, because the stock market is how do I say it? It's got everything. You will have the tragedies and you will have the comedies and you will have the winners. So it's not necessary that every company you pick is going to be great, right? So you're going to have these tragic fellows who appear really good. Because there are ways to excite you by changing the name of your company to /AI/EV/ whatever is the new fad of the day. And it'll sound like, oh, if I buy this company, and then there will be some. So because there is no guarantee of future returns, and you haven't researched the company enough and you don't know enough about it, there will be these companies that either give you glory, sometimes give you glory and then go to bust. And you hold on thinking this guy gave me a 3x return and now he's down 60%. He'll go back to that top, and not realizing that the underlying floor beneath their feet has kind of shifted and therefore things have changed. That kind of thing is always going to remain. I think people burn their hands. The biggest problem I have with people burning their hands is that they don't learn enough from it. If you do, you'll fix yourself.
But today, I think, Deepak, that's changing. With the amount of information, with the number of people talking about markets in all formats, right? Whether you speak about podcasting, any audio-visual, written text format, forums, they're blowing up. And so when both Deepak and I had our first, maybe you must have had your first stock market experience a long time ago, but I first got in 2006. Back then, you were just alone, siloed in front of your computer, right? Not knowing what to do. So your learnings would be much more delayed. Today, the network effect is so good that it's making retail investors mature much faster.
That's good.
That's a bonus.
Even what you do as a platform, right? You also have Algo trading for retail and API connects. If you can simplify that for us, and how has that made trading more convenient? Are you seeing, more people set up their own algo trading strategies? How has that worked? You've also got a lot of SEBI guardrails around that now. So
SEBI is creating guardrails, but to answer the algo question, we started this whole algo thing. There were very few brokers that were offering it. But in 2019, just before COVID, we democratized it by offering trading APIs for free, right? And then all of a sudden, like these engineers who knew how to create trading strategies kind of took to it. The Bangalore, basically people who knew how to code in one language or another, they figured out how to use it. And then before you knew it, over the next 3 to 4 years, you had other brokers follow, created an ecosystem, right? Now, it's obvious that the regulator is going to be concerned about it because they don't know how they're being used. Now, in this whole mix, while there are a lot of genuine use cases, because ultimately people do not have the time to sit in front of the markets and trade all day long, right? So automation makes sense, but it makes sense DIY. But you have a lot of these unsolicited, or rather unregistered investment advisors, or rather masquerading as investment advisors, right? And then giving, mis-selling, promising returns, and then executing advice through APIs, right? This is something which has gone rampant. It's gone berserk and needs to be controlled. Guardrails are yet to happen very soon. It's in consultation stage right now. They've taken over maybe 2 years to think about it, and we're expecting some good regulation soon. But I'd say the future of trading or investing should be more automated. It just makes sense, especially for the employed crowd, right? Because those who are making money are busy 9 to 6 or 10 to 7.
Yeah.
They don't have the time to sit and do this every day.
Yeah, you've got this Fyers intelligent assistant. How does that work exactly? You have a lot of screeners today. You have an AI screener, you mentioned.
Yeah, so it's an AI screener. It's just a beginning for us in our whole AI roadmap. But essentially what it does is it helps you to discover opportunities in stocks 100x faster. So you can have complex conditions such as like which stock fell from, let's say, FMCG sector with more than 1 lakh shares in volume and also recovered 3% from the lows, but did not hit the highs or whatever, right? Like you have complex conditions like this. It would take you an entire day to find this out. But with FIRE's intelligent assistant, it can do that in a matter of seconds. So it helps traders become smarter if used properly. That's what it's about. Because we're building for the smarter investor, the smarter trader.
Yeah.
FIRES is not building for everybody. I've always believed that trading is not for everybody. And I haven't been shy to say that. After all, you only have 50 lakh active traders on NSE trading derivative markets. It's not such a big market. I mean, there's more hype to it than reality. But there are only 50 lakh people. And I genuinely believe trading is not for everybody. It is for those people who have this innate desire to win in the markets, who are willing to go the distance. And that's not a very large crowd.
No, that's a fair, honest answer. And even robo-advisory is like a big thing that's taken off, right? What is your take on that?
It's interesting, but in India, I've realized that people in the end do need a physical connect. You end up, I'm sure, you've been through it.
Trust is the most important thing, and that comes when somebody talks to you, explains you.
Especially for something as personal as finance.
Like the times like when you have a volatile market, if you have a computer telling you, just stay invested. It's very different from a person who comes to you like a Ramesh Damani and says, "Guy, stay invested. This is, I know you and this is what you should be doing." You're going to get a lot more of the feeling of credibility from there. However, it's the normal times when the robo-advisors will do well, I think, because, and you have more normal times than you have extreme times. It's not very complex asset management, but this robo thing has been set up for you and you can't change it. Now you're getting people who are saying, listen, we'll do robo for you, but we can change it. We can optimize it a little bit. We can do this, we can do that. I think it's yet to grow on people, and I'd love to hear what Tejas has to say about that. Yeah.
I don't think robo-advisors, especially the erstwhile robo-advisors, it was quite popular in between 2016 to 2018. You have all these goal-based advisors and all of that. They were not intelligent advisors, so to speak. They basically, in the back end, is very dumb. Just buckets you based on your risk profile, and then there is discretionary categorization of what one must invest in. In the future, robo-advisory will, of course, have to be intelligent with AI, but there is no regulatory clarity about that. SEBI recently put out a consultation paper about this, but it's still being debated a lot whether we should use AI to advise people about the future. Because AI's intelligence is based on the past, right? it's all with the benefit of hindsight.
Historic data, yeah.
So it does it just like us. It knows nothing about the future.
Also, the bigger point is, who do you hold accountable when it goes wrong?
Yeah, that's a big problem.
When there is a mis-selling happen, anything else happen, for regulators, for companies, for investors, there is somebody to hold accountable.
So this will go through the RIA model, so Registered Investment Advisory model. So ultimately, the Registered Investment Advisor, in other words, maybe a broker or an independent RIA, would be held responsible.
Yeah.
With
So there's
enough
still some
disclosures.
combination of that AI, robo-advisory plus some human touch. That kind of a combination should ideally.
And it's interesting because I tried a bunch of AI tools and asked them about compare these two products. And then the AI would give you some things, but some of them were wrong. They said, oh, a mid-cap fund is not as taxed advantageous compared to a large-cap fund. So I'm like, they're taxed exactly the same in India. So, but obviously some AI has read somewhere that there's some tax advantage and it's decided that's what the truth is. But the truth is always somewhere in between, and then you need that. So until AI becomes pakka, it's not going to. But I think one of the things that, I'll give you an example of where it has helped. I personally invested in my own PMS for my son's future education, and we had this goal-based model. We said we'll do it in the PMS model, where we said, okay, no, we'll automatically adjust between debt and equity and all that stuff. And I have consistently invested for the past 5 years, nearly 6 now. Last year in September, I reached a point where I had reached where he needed to be in October last year. In order for me to pay his fees this year, which is when he's finishing his 12th, so I had 1 year of fees, 1 year ahead of time because the markets had gone up. So it's done that for me without me, and although I designed the thought process and all that stuff, I'm immensely grateful that I didn't have to think about this. I didn't have to think about this through the process. So I wouldn't think of, oh, this month I need to be putting money into equity because, the market is down and some Trump and some Brexit and there are too many equations.
Yeah, too many factors.
So now I'm like, just put it, that thing figures out where to put the money and that thing somehow gets there.
But you also have a lot of that context, right? Because you are financially savvy and all of that.
But to be fair, in this case, all I needed was the financial savviness of saying, I need to get there.
Yeah.
And I need to track my way to get there, because when the markets would fall, I would be short. Then I'd say just add more money now.
But I think having goal is also very important when you think of a robo-advisory, right? And when we were at Navi Mutual Fund, we have done a lot of research with customers. And one thing came out very distinctively saying that in India, there are very, very few investors who think about a goal and start investments.
Yep.
Is that they start doing investments, they reach some halfway, and then they say, ki, Acha, now this is 25 lakhs, now this is for my kid's marriage.
You don't know why they're buying and why they're selling.
Right. So once it becomes a large sum, is when you start putting a goal to that, right? So there is no clarity with the investors to give clarity.
But I think that's how it is even with life. You get started with something, and as you do it, you get used to it, and then you try to make something out of it. It works like that. But I think the failure of the erstwhile robo-advisors rests with the fact that they expected investors to come in with an objective goal. This is why I am investing, and that's not how it works when you're just exploring the space.
The biggest problem is when you go to a robo-advisor site, they'll ask you, how much money do you want? They're like, no, wait, I don't know.
There's no upper limit
there's no
on that.
end limit, right? I mean, what, should I start with 100 crores and work backwards till I get there? What do I do? So we created this website which told you how much money you need. We created for the PMS because it was helping us understand. See, if you have inflation and you have there's so many variables, we'll put some numbers in there. And then if you're spending $1 lakh a month today, what is roughly the amount of money you need whenever you're thinking of retirement?
So let's talk about something that, a lot of people are comfortable about, and that just brings me back to the fixed income discussion, Saurabh, stable money, as you call yourselves. Tell us a little bit more about your offering, because, you started off with FD as your hero product. And how exactly are you differentiating it with tech? We've been talking about, the impact that fintechs have been making to actually give like an improved interest rate on FD.
Right. So I'll tell you some data about fixed deposit, right? So 5 years ago, 1 out of every 4 FDs were booking online. And this includes net banking, everything. in the last 2 years, 2 out of every 4 FDs is getting booked online. And it's very surprising to hear that still there are 2 FDs where people go to physical branch or somebody comes to your home and book your FD. So that's the challenge, because there's so much innovation happening on the whole mutual fund and the equity side. This was unnoticed. Now what we are trying to do is we are first trying to solve for the accessibility. There's so many banks that exist which are offering better interest rates for you, but you don't know because the branch is not close to you. They don't have a great website or the tech for you to go online and do that. And there are a lot of other challenges, right? Every bank that you have to open a fixed deposit, there has been a mandate that you'll have to first open a savings account. And then you'll have to create an FD. And now we know the whole taxation, how the complicated process is, minimum balances, everything. Nobody wants that overhead. So what we said, like what in last 1.5, 2 years, is we said that we'll aggregate some of these great banks that are available, which are offering great interest rate, which are under the DICGC insurance. So all your FDs below 5 lakh are insured. So your FD in any X bank which is offering 9% is as safe as any FD that is in the top 5 banks that you have. So first is to get those banks onto your platform, build tech along with them. And there has been some innovation that we have done over this journey, right? First is you can open now FDs across all the 10 banks that we have onto the platform without opening a single saving account. So you open an FD account is open. Once your FD is matured, your FD account gets closed. You don't have to maintain anything. The entire booking, KYC, video KYC, FD receipt tracking, withdrawal, everything happens onto the platform. And now because there is so much need, right? Like the instant liquidity is a great important thing. No penalty, no charges is important thing. So now we are working with the banks to ensure that anybody who withdraws the FD gets their money instantly. Say for example, somebody is parking money into fixed income and wants to invest when the market falls or when there is a great price, right? You can instantly withdraw, get that money into your bank account, do the investments or solve for your emergency needs. So these are some of the innovations that we have done with these banks, because now banks also for the last couple of years has been in need of the deposits and realized that there has to be some innovation happening because the current channels of acquiring customers is not enough. So I think that's what we have been doing for the last 2.5 years. And now we currently have users north of 1 lakh who have booked fixed deposit. And this is coming from across some 900 cities and towns in India, where for some of the banks, we have deposit across all the states and union territories where they have presence only in, let's say, 2-3 states.
That's really interesting. And also, you say that, overall, there is this a perception and a fact to some extent that, FDs have also been demonized quite a bit, saying that, inflation adjusted, tax adjusted, you barely get anything. But compared to the traditional banks of a 5% interest, you offer a 9%. So there is like a, say, 200-250 basis point
extra
advantage that you get.
Okay. Yeah, and that advantage was always existing, right? There are banks where, because of their loan books, NIMs that they have, they are able to afford the higher interest rate. The only problem was it was not accessible. And mostly these are small finance banks which are which are specific or have a high prominence in a particular state which is not open or which does not have access to a lot of other states. So getting those banks which are offering higher interest rate, especially, and after 2020 when the Yes Bank fiasco happened, the DICGC insurance went up to 5 lakhs. It makes a lot more sense that people diversify their investments across 5 lakhs, multiple FDs where all is insured and still get those 200-250 basis point extra on your fixed deposit that you anyways want to keep, because that money is a very hard-earned money, safe money that you want to keep as your cushion, as your emergency fund over a long period of time, right?
So you get that insurance cover of up to 5 lakhs per deposit per bank.
Yeah, so and we also realize this, that though regulators are talking about it so much, there is so much, people don't have so much information about that. It's 5 lakh principal plus interest that is insured. This is per bank per PAN that you can do. So if you do it across 5 banks, it's 25 lakhs that is insured. And obviously there are different ways in which there are joint accounts. So if you can do joint accounts and multiple name 1, name 2, name 2, name 1, you can increase your insurance in the same bank as well.
So what are some of the misconceptions and misunderstandings that people have about FDs, right? Because like if you look at the data as well, I think if you can tell me how much % of FDs are actually parked in traditional banks that gives, say, 5-6% return, and what are the misconceptions?
So top 2 banks constitute 40% of the fixed deposit. Top 5 banks contribute 60% of the fixed deposit.
The top 2 banks are what? SBI and
HDFC.
Okay.
So they contribute to almost 40% of fixed deposit that exist today, and top 5 banks contributes to 60%. That's how skewed it is in terms of the fixed deposit. And major reason is obviously the brand name, the legacy that they have built, and the presence that they have. Right? But if you see a lot of small finance bank that we have now onto the platform, they are growing the fastest. In the last couple of years, they've been growing their fixed deposit book obviously the book is very small, at a 35% year-on-year growth, where for a lot of the other banks is almost flattish, right? So that's one thing. Second is, people always thought that some of these big banks, all your money that you keep is all safe, and all the other banks, the whole insurance piece doesn't apply. That is one misconception that people have, that all these banks pay their premium for all the fixed deposit that gets booked. And this has been traditional setup, right? Because every time you book FD, you go to a branch, and when you want to withdraw, you'll go to a branch, and the branch manager or the people there will say that don't do it, there is a penalty, you will not get the money. And that has translated so much across the generation that even today, a lot of people that we speak to, they said if you prematurely withdraw your FD, you will only get the principal. You will not earn the interest, whatever you have earned, right? And there are so many such things around fixed deposit that despite being there for so many decades, people don't have full understanding of that. So our goal is that these 18 crore investors who will still continuously keep doing fixed deposit, how do you educate them better? And how do you give them that incremental 2 to 2.5% incremental returns on their fixed deposit without giving any risk is the goal.
In the context of today's market then, right, the volatile situation that we're seeing, what are some of the small smart choices that people can make in terms of the FD strategy? I think there's a concept of FD laddering.
Yeah.
If you can explain that, how does that work?
Yeah, so there are, I think one most important thing macro is, if you are looking at fixed investment or you're looking at fixed deposit as in one part of your investment as an emergency fund or something as a cushion, and this is a great time to do those investments and lock in for a 3 to 5 year kind of a rate, because whatever you're getting at a 8.5, 8.6, 9% as a rate, you won't get that after a couple of quarters, right? So you lock in, that's one macro strategy. There is also a lot of things that people figure out is doing FD laddering. If you're doing a 5 lakh FD, you do it 1 lakh for 1 year, then 2 years, 3 years, 4 years, 5 years, because you keep getting liquidity every year. And you also solve for the interest rate risk, right? Because you never know, after 5 years, you'll get the entire 5 lakh. And at that point in time, FD rate is 6% or 5%, right? So every year, if you get and you keep reinvesting that, I think you will be able to solve for that interest rate risk as well. So these are some of the tricks that we go and talk about. But I think broadly speaking, looking at creating that emergency fund as your thing, but getting that incremental return is the broader goal. And our goal as well also is that a lot of people who've gone through these market crash or other personal issues and everything, people don't have emergency fund. They don't know the concept of having that emergency fund, right? So our goal is that through fixed deposit and through bonds, we want to make sure that at least these 18-20 crore retail investors have their emergency fund, which covers for all the worst situations as well.
Right. I think we've looked at, the impact that a lot of new age tech firms have created, fixed deposits on the trading broking side as well. Deepak, you've, I think, documented a lot of India's investment journey. You spoke about how you had to go and fill a form to also buy a mutual fund some time back. What is your favorite part of this, what new age invest tech firms have to offer?
Actually, yeah, I mean, what's happened is this faceless part. Because a long time back, somebody told me this: the problem of the poor isn't that they are afraid to invest or they have less risk appetite or anything like that. But the middleman to their investment was either a broker or a bank manager. And if you came from the poorer class of society, they were looked down upon and they were treated not as equally as perhaps the English-speaking whatever class. You suddenly got tech that has leveled this, right? Because I don't need to talk to a human being in order to invest. I can go to some app, move my fingers here and there, and I suddenly have bought a stock, I bought an FD. I can do this, my mate can do this, anybody can do this. And when you do that, you've suddenly empowered a section of the population that had a barrier that we have removed class by just introducing tech into this equation. It's such a game changer. UPI did that for the payment industry. Because to deposit money into your own account in certain banks, you have to stand in a line and take a token in the morning at 6 o'clock to be able to deposit money into your own account. Now you don't need to deposit money into your own account because you're paying with a QR code, with an app, and things have changed. So you're changing these class barriers. So it's creating real human change in a way that has never been imagined before. I think that is the real story, right? Because in the end, money can do a bunch of things. It can make you happy, it can make you spend. All that is fleeting and temporary. But when you see that these class barriers eliminated, I think that is just fascinating. And the reason you see 18 crore people, because these 18 crore people don't speak the same language, don't live in the same geography, sometimes have work to do in the mornings and in the evenings, and when you can't get them together at the same time, they are making investments at midnight, from their phones. They are making, they are giving money to other people. They're educating other people through the communities that, the same websites have created in different ways. That's a game changer. I think that when you say this fintech, I think it's bigger than just I enable you to buy options or trade derivatives, or I enable you to buy FDs. I'm actually changing lives. And, to me, as a person who's a recipient of this, I can't thank them enough, because I think they've really made it possible for people like me to run a business.
I'll tell you one small story, because he spoke about that. Is we have a customer who has moved from UP to Ooty, fireman, with his family, can't speak the language, doesn't know how to go to a bank because everybody is speaking that language. He's also not very well versed with English, and has used stable money and all the FDs that they have done. Moved slowly, building trust. First book FD, break FD, see it comes in your account, call the bank, go to the website, call support, get all the answers. And once finalized, move the 6 lakh FDs that he has saved over a period of time, completely to stable money, without going to the branches or the banks, which might not be speaking the language that he's coming from.
It's a big deal if you look at it from that perspective.
Yeah.
It is a big deal.
And so if we talk about, the investment habits then, in terms of where are Indians investing, what is the largest asset class that they use as well? Is it still gold and real estate? Is it fixed deposit? Is it mutual funds?
We'll have to break it down. I think urban Indians, semi-urban Indians, for them, it's mutual funds and direct equity, for sure. There is no second guessing that. There is data for that. And also the mindset is equity. India has a very equity first mindset, right?
Okay.
The gold culture is maybe fading from a generational standpoint. India hoards a lot of gold, which is great. You have companies like Muthoot and Manappuram doing excellent work by helping to monetize that gold, which is otherwise considered an unproductive asset, right?
Yeah.
Other than that, equities any day of the week. So what we've seen, of the total household assets, 10% is currently in equity or thereabouts, right? But if you isolate that with just financial household assets, approximately 30% goes to equities, both mutual funds and direct equities. But also it is relative to the overall financial assets, which combines insurance, FDs, and the rest of it, right? So the equities is just going through the roof in terms of how people like to invest in this country.
That's an interesting change of, because otherwise it was always gold and real estate.
Another point is, moreover, people want to invest directly more than mutual funds. That's a big takeaway, right? Because they're more comfortable, they feel more independent, they feel like they can earn money with their own wisdom. And that's the big trend. Especially when you see the median age of investors in India is actually slightly lesser than 30. It's in the range of that 28, 30. Which means that the population that has started to earn and has not yet matured, right? They're yet to buy their first house, But before that, they have inculcated the culture of
Like an
investing in
equity first kind of a thing.
Absolutely.
But like if you talk about the context of the current market, would you say that gold is also a place where basically you talk about it being a hedge and a good asset to park during volatile times? So what is your take there? Is there more upside left? We've already seen gold going up. So.
I'm not a big fan of gold, and I'm a terrible person to ask about gold because I've always been negative on it.
Why so?
I think it's a great thing to spend on. It's like a good car. You want to buy a good car, you want to ride it, you want to buy gold jewelry, you want to wear it. The minute you start treating it like an investment, have you ever tried to sell gold for cash? Life becomes very complicated. First of all, there is a 10% spread between the price of gold that you see and the price that you will actually get when you sell it. And then they will put some wastage and some this thing and some other charge. By the end of it, you're giving like 15% less. We talk about 2% entry exit loads being too much. Here you have a 15% spread and you're perfectly fine with it, which sounds alien to me. Now the third thing is gold has, for the most part in the last 10 years, given you returns of a rupee depreciation versus the USD. Not so much because the gold prices till recently were about $2,400, $2,500. Now it's gone to $3,000. In 2011, there was a price of 2,000 and then it fell 40% and then came back.
That's right.
So if you take a 2011 to 2025, that's 14 years, you've had a 50% rise in 14 years.
Okay.
It's about 3% a year. So you're getting 3% a year of an increase from top to top, if you may. I mean, if today is the top.
But you're also cherry picking the starting point.
I know. I'm just saying that if you assume that you saw a 40% downturn in the middle, so from the bottom, at a 40% loss, the money has doubled in 14 years. Even if you double your money in dollar terms in 14 years, that's a 5% return. So it's not meaningful. If I look top to top, it's a 3%, less than 3% return. If you look at bottom to top, it's a 5% return over 14 or 12 or 13 years. It's periods in the middle that have given you great returns. But these long-term holding, which is what you associate gold with, have not given you meaningfully great returns. But there have been great points where the points at which they have been most helpful is times of extreme uncertainty.
Like when you hedge, right? Because I think there's a huge affiliation now towards gold mutual funds.
And in my view, whenever things get very, very popular and you can't miss them, it's not
That's
the right
when
time
they've
to.
peaked, perhaps. But I have a different view about this. The holding period of anything gold is hopefully a lifetime, right? And the kind of people that monetize this come from a different financial background who have different financial realities to deal with. If you look at it from their perspective, what else would they invest in? Equities. I mean, it's such a complicated asset class for people who are not so educated about it, right? And it's also even for the educated, or even for that matter, even for professional fund managers, they find it so hard to grapple with during times like this. Gold is that one asset class where you put your money in and sleep over it for a lifetime, and you monetize it as and when you need to, if you need to. You never want to, but if you need it, it's there. And at that point, the making charges, the spread, the fact that the crystals have lost their value and all of that is of little consequence if you look at it from that perspective. They're not really looking at it from a mark to market. I need to make profit on this investment. So
if you're looking at it from a fixed long-term kind of a thing, then, like now SGBs have been discontinued. There's a lot of demand. You're launching gold, mutual funds as well. So, what is your understanding of the dynamic?
I think for us, our customer is coming from that very conservative, the exact point that he has mentioned, right? Where they have fixed deposits, some cash, some real estate, some gold, where they always associate this is the gold still as an investment.
Okay.
I think couple of times you have read and customer tell us saying that 1 kg gold 20-30 years ago was one house, still one house, will be later one house for you people who are in these tier 2, tier 3 cities, right? So that's how they associate. It's more of passing on tradition, all of those things. And they have seen price change. Like my mom talks about 7,000 rupees gold to now going to 90,000 rupees gold, right? So that's what we believe. So there is still that investment that keeps going. And today, as you mentioned, that physical gold has so much complexity. There is that price differentiation, there is a storage cost, there is this making charges, all of these things. With SGBs out, we believe that if you have to do gold investments, it can't be digital gold. It has to be the gold mutual
I
fund.
think it's a hedge against depreciating currencies. We ultimately do live in a world where inflationary economics dominates.
Yeah.
Right? And so it's a natural hedge against the US dollar. It's a natural hedge against Indian currency depreciating. And it's also considered money worldwide. Even today, the whole reason why central banks are stashing up on gold is because they consider it to be money in some sense, right? But with respect to what's happening with the whole gold ETF, gold mutual funds, there it's more portfolio flows. There is no emotional association. So hence the holding period of financial gold is far lower.
Okay. And now we're talking about holding period, and India's investment habits. What is the average holding period for a mutual fund?
So here's the interesting thing. Indian mutual funds have largely been domestic investments, right? So till 2013, the net inflows into mutual funds in terms of rupees and the net outflows into Indian mutual funds were exactly the same. That means net people just took out whatever they'd invested. They left their profits inside. And since 2014 or so is when, or 13 or so, is when India has actually started really investing in that market. So it appears to me that the average holding period was less than a year for mutual funds, or a year or
You're talking retail.
retail. So recently, when you look at the AMFI data, those charts look scary because the number of people holding on for 5 years or plus is a number that is increasing
Constantly, yeah.
constantly. The other point is that mutual fund universe itself has changed. So till 2009, there was a 2.25% entry load.
Yeah.
So when you bought something for 100, you got 97 rupees or 50 paisa off something. And then in 2013, they said, oh, there's a direct fund and there's a regular fund.
Right.
So everything that was a fund was now a regular fund. And then what is not regular is direct. So you don't know what to make of it, but somehow you have to like both of them. So regular is where you pay commissions, direct is where you don't pay commissions. This was not popular for the first few years. Suddenly people started realizing that if you don't pay commissions, you make a lot more money. And then there were advisors who came and said, you sell that and buy this.
Direct,
that would have changed your average holding period, but it's the same fund that's been, moved.
Having said that, advisors are having such a hard time because now everyone wants to buy direct mutual funds. So the regular guys are suffering so much. Most SIPs are now moving towards direct.
Oh, and here's the interesting part. Sometimes it's a bad idea. And I was telling somebody this recently. They said, how can it be a bad idea to buy a product that gives you lower returns? And I said, this is...
They're investing in the wrong product?
No. It's not like that. It's like this. If I go from regular to direct, maybe I'll save 0.5 to 1%. That means I'll make 1% more. Right? So I'm assuming the average returns. So I just did a math. And I said, listen, if I need this money 3 years or 4 years down the line, does it make sense to switch? You would say, well, with 1% more, I'll make so much. But here's what happens now. Suddenly things have changed. You have a long-term capital gains tax. So if I take out 100, I have only 87 rupees 50 paisa left to invest.
Yeah, it makes no sense.
Right? So I'm actually paying the income tax today and only the remaining money is compounding. Whereas if I let the entire money compound, even at a 1% lower rate,
Net you lose.
for a 3-year period. So it entirely depends on how much profit I already have. So my rule of thumb now is, if you've doubled your money in a mutual fund, then your holding period needs to be more than 3 years remaining for you to make a switch from regular to direct. If you expect to take out the money within 3 years, stay with regular.
Because of the tax implications.
Because this tax compounding is just going to hurt you and unnecessarily. So it's no longer
that's something that needs to be paid attention to. Nobody talks about this.
Nobody talks about it. I was telling somebody
because it has become so easy that you go onto any app and they say switch.
Yes.
You will earn so much.
Yeah.
Yeah, and it's not true. It's nuanced. And sometimes I tell people I hate ULIPs as a concept for the most part. I don't like them. But then sometimes you give me a policy and I'll say, listen, in my fiduciary capacity, if I'm telling you this for your best interest, it is to stay in this horrible product. Because if you get out, they give you only 30% of your money. But if you keep paying the premiums for another 3 years, you'll get back whatever, 100 or 50.
Yeah. No, there's so many layers to this, right? When you talk about India becoming an investor nation versus, being a saving nation and the financial literacy gap, are you actually seeing a turn on that front as well, that we're becoming an investor nation now?
Yes, in the sense that a lot of the products that you see in everyday life are now reflecting as listed companies.
Such a good point.
So more tangible.
So you can see it. Like, okay, tomorrow if YourStory listed, YourStory is a household name, I would kind of say, I want a piece of that. The people who smoke, and it's a bad idea, but you want to benefit from the smoking as much as you want, you can buy an
bad
ADC company.
example. But yeah.
I'm just telling you, it's a lousy example, but you see it everywhere, right? And then, there is, so my question about financial literacy is, how many ads do you see on TV whose companies are also listed? These are like, this is a strange part for me, because there was a time in life when I would look at these IPL ads and just think of myself as, how many of these companies are listed? On the label of the t-shirts of the people who wear this thing, you will find at least 8 listed companies whose name you wouldn't have probably heard in ordinary life. Like a company called BKT, which makes tires for monster trucks and construction equipment. So it's interesting because they're now on the right side of every t-shirt, and there's no reason for them.
The cricketers.
The cricketers. How many people who are watching cricket are also buying construction equipment or monster trucks? Chances, but there's a reason for them to stay in people's eyes, because their biggest competitor in the world is Michelin. Basically, even those companies are advertising because they are also listed and they have to be in the having some kind of a presence. And stuff like that. People want to touch and feel these companies. They want to know these companies. Tomorrow, if BKT was to get into regular car tires, you would suddenly have a mass of people that says, I know that brand.
Because IPL is the biggest advertising avenue.
Eventually, it's like this. Companies will list because there is no other way to exit. There was a point at which everybody's exit was SoftBank. So SoftBank would come and eventually buy your company, But SoftBank ran out of the currency required to buy all companies. So people started saying, oh, let's exit to the stock market. But then now the companies in the stock market are like, oh, wait, there's more, we can do more. There are companies that listed in what was sounded like a distress sale at 70 rupees a share. They are today quoting at 3,000 rupees a share in 3 months. And I'm talking about 4 years of listing. Startups listed, funded by Bangalore-based, Indiranagar-based VCs. So who have listed and done this. This structure of investing in equity, I think is come down to, I know this company, I work in this company, I do this. So a Swiggy rider today can actually buy a share of Swiggy and participate in the company's profit.
But it's going till the bottom. It's not only public markets, but privatized. Like, so much of your primary circle is now doing angel investments.
Who's doing angel investments?
Retail investors have started doing angel investment. There are platforms. So it's slowly getting into.
If you made some money with ESOPs also, you can become an angel investor.
And by the way,
that's actually the most scariest path, because these angel investors, those who invest like a little bit here and there, a few lakhs, that most of that money is going down the tubes, by the way.
Which is actually good, according to me. India should learn to fail big, in the sense of all capital that goes into trying new things is good capital. Because it is, if you succeed, you succeed. And if you fail, you give the platform for the... So Dunzo was the original instant delivery market. But Dunzo's gone. And nobody misses it. But you know what? It created this for us.
Talking about IPOs, right? The other huge trend also is retail investors getting into IPOs last 5 years. A lot of startup IPOs coming on board. So I want your views on that. And I think Tejas, very interestingly, you mentioned that you started, one of your initial journeys flipping IPOs.
Right.
And now, tell me a bit about that, because here among retail investors also, the idea really in terms of making money from an IPO is to make those listing day gains. Is it the right way to look at it? Does it make sense, when even here you may not have invested in anything, but you will invest in an IPO. So how does that work?
In the ideal world, it's not the right way to invest in IPOs, right? But the retail investors are also getting smart, because if most startups that are funded are exiting in IPO, right? They're trying to maximize the exit value. Right? So retail investors also understand that now. If not all, many of them have started to understand that. So they also want to make the quick buck. When the wave is riding high, just make a quick buck and get out. But let's not forget, bulk of the money raised from the IPO, from all IPOs, bulk of it has been OFS, right? Hyundai was the largest IPO and it was 100% OFS. I think the
Just explain
attitude
OFS a little bit very quickly.
offer for sale. So let's say a company comes to the market to raise 100 rupees, right? What is that 100 rupees going to be used for is more important to understand, right?
And it
If
can
it's-
only be used
if
for
they
that.
use, if let's say Hyundai uses that money to set up new factories, more dealerships, more service stations, then that's fresh issue of capital. But if they're using that money just to sell their equity and take that money back
got
home
it.
to Korea, then that's OFS, offer for sale. So they're selling their equity.
Yeah.
Coming back to this, I think the attitude is changing as when we see a year or two where new companies raise fresh money to expand their businesses in the primary markets is when you will see the attitude change. It's a chicken or egg situation right now.
Okay. And also, because you focus a lot on trading as well, F&O is an instrument that's largely used to hedge strategies per se, a leverage instrument, but people seem to have misunderstood it a little bit. Like, do they have enough knowledge? So can you share data there? Because like you mentioned, there's an influx of retail investors getting into this post-COVID as an option to make quick money. We've seen a whole host of SEBI rules and regulations lately for the equity index derivatives as well. So tell me, how that is really shaping all the market action that we're seeing here now.
Right. So derivatives are originally invented to hedge, but it's no longer used to hedge that much. It's a speculative product. It can be used for hedging, but I think as a system, we need to appreciate speculation to begin with. Speculation is not evil. Speculation brings liquidity to the market. It helps to discover the real price discovery aspect, which is so important for markets, right? If in the absence of speculators, you can have Warren Buffetts on both sides of the market trying to trade with each other, but they won't be able to buy or sell. There'll be a never-ending negotiation. So speculators solve for that. With respect to F&O markets, there is zero-sum game in theory. In reality, there are negative-sum game because of transaction costs. So only the really competitive guys need to be there, but those like the first-time users onboarded by many of these mainstream brokerages, they won't last too long. Their journey in F&O markets will probably be 3 to 6 months, and they're not losing so much money that they will go broke. Right? They experiment with it a little bit. If it doesn't work, they move on and maybe become mutual fund investors or IPO investors down the line. So one can think of it as a pull factor, maybe not the right way to look at it from a broader standpoint, but largely I think that's been the approach. But the underlying symptom is that people really feel the need to make money, and that's why they're in derivative markets.
So how do you encourage them to be more profitable or say disciplined in their trading? And the other important thing is also how do you stop people from over trading? Because that's also happened a lot.
Let's say we're running a gym, right? A really large gym with a lot of facilities, equipments, but it's a self-service gym. We're not really coaching everybody. So what can we do as a service provider, as the gym owner, so to speak? Great equipment, good maintenance, spacing, layout, caution, right? Red alert on what not to do maybe. But that's as much as we can do. We're not really trying to tell them which exercise to do and when and what result it will bring out, right? That's not our job, which is why I was saying it's really not right or possible to advise people on how to trade at scale. It's really not, I would say it may be possible in theory, but the outcome wouldn't be ideal in any sense. So what do we do to help them become more disciplined? First of all, we don't cater to those who don't know what to trade. We don't encourage trading. But those who want to trade, they discover us because we're building for a more evolving user. So we introduced a feature called Take a Break, similar to what you have on YouTube when you watch videos all day long, you get distracted. So we introduced Take a Break. We have other like checks and balances through something called Smart Orders. We're the only brokerage in India to offer conditional smart orders, which will help with the execution and to optimize so that you're not constantly kind of addicted watching the screen all day long. We have a full stack set of APIs that help to automate trading. So we have that we do to help inculcate some kind of discipline, because automated trading lacks emotion. So maybe that helps for discipline. We introduced journal, right? So we have a journaling platform. And journaling is very good in life in general, right? It helps you to reflect upon your actions and plans. So we introduced that so people can sort of reflect on trading, make plans, and stick to them.
Yeah. Great. So, basically you're saying if you don't have enough knowledge about a product, even if it's going to make you that money, don't get into it.
I won't say don't get into it. You never know until you try. You have to try.
Because in trading, I think the whole thing is about risk management and not like...
Yeah, but how does one recognize their own abilities, right? Like you need to, if you want to know you're good at swimming, you got to be in the pool. So I'm not saying that everybody should do it, but those who feel an inclination should certainly try.
There was a movie called Trading Places. I don't know if it was Eddie Murphy, long back. Based on probably what a true story is, where a guy called Richard Dennis, who said he can teach anyone how to trade, but if they have the right mentality.
Is this to do with turtle trading?
Turtles, yeah. The turtles, so he says, I will breed traders like they breed turtles in Singapore, which is in a farm they just put stuff. In Trading Places, they have personified this by this guy just choosing Eddie Murphy walking on the street and saying, I'm going to make him a great trader. But just give him a set of rules and then trade. People who have the mentality to follow rules would make a lot of money. These people made a lot of money simply because they had the temperament to follow rules. And this Richard Dennis gave them the rules. Buy when this happens, add when this happens, sell when this happens, and so on. And these turtles ended up making a lot of money for Richard and then later for themselves because they were following rules and discipline. So you can learn the game and write it out, but most probably you don't even know if you're not allowed to be exposed to the game in the first place. Yeah, and you can't tell people don't write the IIT exam because the average person doesn't get a seat. That's like, because you don't know whether you're average or not, and it's always worth trying.
If you talk about creating an ideal portfolio for an individual earning, say if you want to break it into brackets of 8 lakh, 15 lakh or 30 lakhs, like what would your initial ABC rules be?
It's a very good question. I hate to answer this question because everybody is different. Personal finance is personal.
Yeah,
right?
yeah.
The first thing I tell people who are young, who are trying to invest, is don't. You're young. You can spend that money learning stuff that will give you a higher income in your life.
Okay.
So this 10,000, 20,000 rupee that you invest is not going to make a meaningful difference in your life long term than using the same 20,000 to take, I don't know, a course on AI, something that else, a travel, a trip, something that teaches you things that you would otherwise not learn. So one is that. Second thing is, now let's say you've gone to a point where you start making this money. I just divide lives into personal buckets. You need an emergency fund. This emergency fund will deal with, you deal with things and you put that into an FD, you put that into a liquid fund or something like that, just to make sure that you're taken care of in case things don't work out in your life. Then you get into this stuff you have to save for, which is your kids' education, your maybe a marriage, maybe a down payment for a house or whatever it is that you want to actually spend on at some point in time. These are things that you plan for. This is second layer. This is where your 8 lakhs and all that stuff makes sense, because you're saying, okay, I have 8 lakhs. And suddenly I've realized, I have to plan for my retirement, for my kids, this thing. So I might bucket this goal down to saying, okay, I put 3 lakhs for my kid, 2 lakhs for my house down payment, something like that. And then I'll add on to this every month. You can use tools to calculate where you are. The simplest thing about where to invest in my fund is this, okay? I think people overrate their risk appetite in bullish times and underrate their risk appetite in bearish times. Always. So at any point in time, if you're confused, do 50-50. 50% in fixed income, 50% in equity, and keep investing that amount every month. Over time, if equities give you more returns than your fixed income, your 50% will naturally move up to 70-75%, and you won't feel it because you've always done a 50-50 kind of a rule. And over time, you'll grow to a point where equity is a large part of your portfolio until it comes to be a time when you're close enough to a point where you have to take out the money, then move out of these equity things, go more into fixed income. That is the sum total of where you need to be. That's it. Just buy your, a flexi cap fund or an index fund and you're done. It doesn't need to be more sophisticated. You don't need to be getting the highest return possible in every possible time frame. Ek saal mein mera best return, but not in the 5 year. I want to move to the 5 year product. The more you're doing this,
You know, and also talking about what you do with the information you have or the money that you have, just going to segue into the budget 2025, right? Because that was a huge announcement in terms of leaving more money in the hands of people. If you look at the new tax income regime, about 12.75 lakh is effectively not taxable. So, you know, under that, do you think that this will empower more spending, more liquidity, or disincentivize structured saving, and people will invest more or they will spend more? What is the trend you're seeing with this extra income that people have in their hands now?
okay, let me give you this example. If Saurabh is doing FDs at 8%, my contention is that you can take 1.5 crores and put it into an 8% FD and pay zero tax on it. Because 8% of 1.5 crores is 12 lakhs, and 12 lakhs is non-taxable. So your parents are retired, and if you have a lot of money, you can say 1.5 crores, please put in FD each.
Yeah.
And both of you have no other income, you pay no tax at all. Why do you want to invest in equity? Take that money and spend it, or use it for your living. This is even better than equity, because if I invested the same money in equity and earn the same 8% on it, it would be taxed, because capital gains applies regardless of whether you're 12 lakhs or not.
Yeah.
Right? So essentially, an FD makes it better. It is better to have an FD for a very large population, because 1.5 crores is a lot of money. And to a very large population that does not have any other form of income, an FD is now a better way to invest than even equity or mutual funds or something like that. So for an equity guy to beat this, he has to earn 15% and 17% and all that stuff for it to be meaningfully higher, so that post-tax it can be coming close to this. So at some level, it has changed the investing preference. It has changed the spending preference. That's left to be seen, because India has domestically been a saving country, right?
Yeah, so also I think the larger point in terms of keeping it simple, Deepak, as you mentioned, and Saurabh, if you can also weigh in on what are the frameworks that you would use to sort of build your first level of a portfolio, because there is also, you mentioned emergency fund earlier. There's a lot of interest, renewed interest now in FDs and bonds, debt funds, all of that. So how much would you sort of, weigh in terms of setting aside as an emergency fund? And what is the framework that you look at for?
There are multiple formulas running. I think one thing that I've realized is there's no one formula that will apply to everybody.
Yeah.
But average is 12-month expenses, 18-month expense, and depending upon how many expenses that you have, is generally what you put at emergency fund. But I think one thing that I've also realized is when you look at your investment, you also should look at your primary people around you and club that together. I've seen a lot of people using this mindlessly and saying that, okay, I'll have to start with FD, where their entire parents' savings is completely into FD. So how do you do a portfolio allocation with this closed network that you have and don't look at it completely individually is one thing that we have seen. Second is, I think there's a very simple thing that we are also saying, that you start building your emergency fund and keep moving upwards of your risk laddering very quickly and see what suits you and keep moving upwards. So you do FDs, you then move to 11-12% bonds, then gold, and then eventually gets into mutual funds and equity as they scale up.
What are your thoughts on this?
I feel very differently, but I'll keep it short. The younger, the better. The earlier you start investing, the better you will be, because you have less money to begin with. So you will lose little if you're not good at it. And you pay a smaller price for learning. That's the first bit. But I also think largely, right, with the different approaches to investing, that if you want to make money in the stock markets, you have to take risk, right? Yeah. So I believe one should be weighted mostly towards equities, especially if they're younger. Because ultimately, I mean, if you're in the stock market to make money, you're not there to save money. You're moving money from saving to the stock markets. And that's for a reason, because you're motivated by greed. And so you got to be greedy, and you got to do it far more Then the other way of planning it is more emergency, goal-based and all of that. But it depends on what people want to achieve out of the stock markets, really.
What are the mistakes that you should not make while getting into equity?
I mean, there's a laundry list, but largely I think people should think about risk management at least, not be overweight on any one stock.
Yeah.
Be committed to equities and not get afraid. You must have courage, right? And courage is an important quality. Most people don't have that. So it's a fine line between risk management and courage. One needs to have that. But what not to do, I think, paying too much attention to the nitty-gritties of financial planning at an early stage, I believe. Because the earnings will get bigger and bigger as one progresses in the career, right? So you'll figure it out on the go. That's what I think.
There's a Larry Hite saying, right? It says, if you don't bet, you can't win. And if you lose all your chips, you can't bet.
There you go.
So don't take too
said it
little
in
risk.
such a beautiful
yes,
way.
That's it.
Yeah. So there's also this, the general perception or the idea really is that you buy low and sell high also, I mean, that's the general principle that
But it's
people use
hard
in
to
equities.
do in real life. It's hard to do in real life. Buy low and sell high is easier said than done.
Yeah.
Because when your emotions start to interfere, you're doing the opposite before you realize.
And buy low and sell high is just that you have to sell higher than you buy. It doesn't mean you buy something at a price that's cheap. You can buy expensive things and sell them at an even more expensive value. You can buy cheap things and then lose all your money from that also. So it is not, it's nuanced. Buy low and sell high sounds like a, don't die.
Yeah.
I mean,
That brings me to the question of rebalancing your portfolio, right? Then how do you sort of figure out when do you rebalance your portfolio? How do you rebalance your portfolio? Calendar based, market cycle based, threshold based? What sort of strategy do you follow?
the
would
quick
you
three
advise?
things.
Yeah.
I have 3 things on, when you want to sell. You want to sell for only 3 reasons. First, whatever you bought, you didn't know why you bought it or it didn't perform according to the way you sort of wanted to buy it. Then you things have changed, so you want to move out of it. The second thing is you found something else that's better. That's also a good reason to move. Third and most important reason is because you need the money. And sometimes you can predict it, sometimes you can't. So for instance, my kids' education, I could predict it. So I rebalanced primarily so that I could be in cash or fixed income when a time I needed the money. Sometimes I can't predict it. I need it for something that just came up. And you sell at that time. You don't ask about why and all that stuff. So if these are the reasons to sell, these are also in a way a reason to rebalance. Because you move from X to Y and you should know why you're moving from that X to Y. This, in a turmoil time, is a great time to think about rebalancing. Things are changing. Donald Trump is saying X things and Y things every day. And you might say, listen, at a certain point, I'm going to get to a point where X is not attractive and Y is attractive. So I will move from my X to my Y, but I have to make that call at some point. Just don't make it on a whim and a fancy, the way Mr. Trump seems to be doing on a daily basis. Instead, do it on a more like analysis-based thing.
I think, but it also happens very organically. I've seen a lot of people putting a very formula to this, saying that, okay, no, this is the time, this is what I should do, and this is 35%, 65% age, this, that. I think everybody is going through a very different cycle, kids, marriage, planning, all of those things, right? So I've seen a lot of time it works beautifully well when it's very organic. Now market has happened, you have put all your eggs in one basket, you realize that this is not working. I believe in this concept more now versus what somebody would have told me. Now I'll start doing the portfolio rebalancing. And then at that point in time, whatever suits best, then you will rebalance again after that. So don't push yourself in saying that, okay, every time 3 months, 6 months, I'll sit and start doing the rebalancing.
Yeah, fair. And how do you sort of also figure that you are either over diversified sometimes? That is one. And the other thing is, like you said, of course, it's personal. But is there a way to automate your rebalancing?
Of course, there are ways to automate rebalancing. It's easy. Like today, you have the tools to do it.
Yeah.
But with respect to why one should rebalance, they should always chase the bigger opportunity, right? Market should always look at the opportunity cost That's a big factor. I keep coming back to the concept of greed. You want to make more money than what you can make in your current investments. That's a huge consideration. And rebalance, it could be a big part of rebalancing.
No, but should you let greed play out that much? I mean, we've been talking about how do you balance greed and fear also, right? At the outset of this entire conversation.
Like if you want to balance greed and fear, then you do a equity debt asset allocation and you're done. But within equity itself, you're constantly chasing better opportunities.
Okay, I'm going to come back to the point of, why we make these investments and savings and park our money and all of that. You briefly touched upon FIRE, and the whole point is also at the end, you sort of live a comfortable life, you retire, and you have your savings and investments to back you up. Does FIRE as a concept, work in India? Because we don't also have, so much of the social security that other nations and developed nations get. It seems to be a movement that's caught on YouTube a lot here. Is it just a social media Instagram trend that we're talking about? What is your view?
My truthful thing is, I don't think this retire early thing will work out very well. But financial independence is always desirable.
Yeah.
Because it frees you from doing. It depends. It means different things for different people.
Yeah.
For a woman, it might mean independence from the social norms that we somehow construct, which is anti-women of sorts. For a person from a poor family, it means uplifting his entire family out of X. Financial independence is a worthwhile thing to chase, and everybody has a number. The problem is most people's numbers keep changing as they go up. My first company in 1998, 4 of us wanted to make 32 lakhs. Because 32 lakhs was the cost of 4 Tata Sierras, which was a SUV at that time. And it was 8 lakh rupees each, and we were 4 co-founders. So our entire aim at that time was so miserably like that. A person who's been in the defense, who comes out at the age of say 50 after a retirement, may have enough of a pension that they don't need this FIRE thing, right? They've gone through FIRE technically almost to get there. So to at that point, you're not going to tell them FIRE is a concept, but they're going to get an income that's increasing every year for the rest of their life. They don't need this corpus to make them that kind of money. But on the hand, like people like us who are maybe entrepreneurs, where if I lose my job today, I will not get another job because I don't have a meaningful resume. You need some corpus to kind of back yourself. That is desirable, I think, but this retire early, I don't know what. Honestly, I thought it'll be
I think
a great thing.
one point here, just to add, is having that there are no multiple threads running in your head. I think for me, financial independence is, if I have financial independence, I'll be able to do a good job what I really wanted to do, either be with family or do my startup or work or anything. So I think that is more critical than this whole retire early piece and putting a number to it by 30, 40. Like there is number floating, 10 crores in India is that number.
Early retirement, I don't think it makes sense. In a person's career, if let's say somebody has done well, there's no real reason to retire early because of course the odds are that you will make more money as you age, as you build expertise and rise up the hierarchies of any corporate ladder or even in business for that matter. But apart from that also, like Deepak said, what will you do? Right? A man needs a purpose to live. Like when you've done something for like 3 or 4 decades in your life and then all of a sudden you're going to live off of something that you invested in a long time ago and be happy, that's unrealistic in my opinion.
I think that's underrated, the sense of purpose. And you find that a lot in, even for instance, people who've retired, women who take a break to take care of the kids. After 10 years, the thing they lose most is that sense of purpose, right? And we need it. We need it to stay alive. We need to keep ourselves going. At some point, I think that is, but the thing is, I think you should always make a difference between, if I have enough money, I'm going to take a lower paying job. I'll still work, but this work will give me happiness. Maybe I'm a teacher, maybe I'm a part-time X. I'm a person who takes people on guided tours to treks around Bangalore. Not going to earn me a lot of money, but I have so much money in my
They
corpus.
find purpose in it. It's not about happiness really. Happiness is a very temporary
Yeah.
state. But yeah, a different topic altogether.
Yeah, we're getting philosophical, but that you get philosophical about money as well. I guess the whole concept of retirement is also evolving, and that brings me to the other end of the spectrum, which is the Gen Z, right? Like the population that's coming into the workforce and all of that, and how they look at a lot of things. Their lifestyle. What does money mean and investing mean for them? Because there are two ends there, because you have people who are not prioritizing say home ownership. They don't have those large end goals. They want to live an asset light life, not taking too many loans, leaning towards experiences over assets. So how do you think their investment culture will really evolve? And on the flip side, there are a lot of them also willing to take those risky bets where their first investment is equities. It's not like a fixed deposit, like our parents.
No, I think this particular, I'm not able to understand even at work how these Gen Z population is thinking about whole investment to work and all of these things. And especially, I think somebody who has got into this workforce during the COVID time. It's very tricky to do, at least for me to see how they'll start thinking about their long-term investment. But I think right now nobody's thinking about 5-10 years down the line what I wanted to do. I've seen so many people in 2-3 years leaving everything and just doing this as a full-time investment, which is also good, as you mentioned, that early stages take those bets and
if you really get deep into it.
But like, how focused are you, and will you be able to do that for the next 3, 4, 5, 6 years? I think is important.
Is their stance a little dangerous when you just look at it from the investment and savings?
So from the time when I was young, and I was the Gen Xer at my workplace doing stuff, to now, every new generation seems daunting to the one that's preceded.
Yeah.
So I would say at this point, figure your own thing. Take those mad things that you're doing and find meaning out of them. Eventually, you'll become us. That's the way life is. You will hate the Gen Alpha generation or not understand the Gen Alpha generation. But I think it's fine, because people now are much more willing to take risks than I was. When I started off my entrepreneurship journey, people thought that I started a company because I couldn't get a job. Because it was not so unpopular at the time.
It wasn't mainstream then.
Yeah, it was 1998, and you were like, why were you starting a company? Why what is wrong with you? So I think we are going to say the same things of the next. Today, if you're not, are you really doing anything if you haven't angel invested in a company, if you haven't started a company yet, if you haven't coded AI in your vibe mode at some point? So, I mean, it's new, but it's all the same things in a different package, right? But I think you should do, what I would give to them is just have more experiences and figure things out, because eventually you are the next generation of entrepreneurship that is going to drive India to the future. That it's the new generation that always comes and creates change. So the same way that the millennials probably came and gave us the Flipkarts and the Olas and all that stuff, it will be the Gen Xers that will give us the next set of even more fancier startups. But in order for them to do that, they're probably going to have to go through a learning through fire in different ways. And that is going to give us that. And this is philosophical mostly, but I think they will earn their money the same way our generations did eventually, by saving, investing, etc., etc. But some of them will earn ridiculous sums of money by starting up and growing the startups and all that. And this is more acceptable today than it has ever been. And I hope that happens.
What is your take, Tejas? Are they also willing to take a bigger bet on the India growth story as well? In terms of investing, are you seeing a lot of them putting in, say, passive and index right now as their first investment?
Passive investing will take a long time to prove its worth, because active fund managers have been outperforming the markets. The PMS guys and the alternative investment guys have outperformed the markets. So passive rises when active fails, right? And fails for an extended period of time. And that it becomes obvious that...
Do you compare it like that, or do you just say that, okay, the market is, say, I believe in the long-term growth story, and hence I will at least take this cushioned sort of stance and I will get...
Not really. Let's say if active investors are outperforming or doing well, then the first instinct is to invest with the best guy who invests my money. That's the first instinct. Only when there is a proven track record of them having failed, on their promises or to outperform markets is when you look at passive in the first place. But just to touch upon the whole Gen Z thing that we were talking about, this is a generation that embraces risk. They're young, right? They've seen money being made. They don't understand the concept of delayed gratification as much.
Yeah.
Because much of the consumption happens at an early age. Also, the way in which most of them must be brought up in urban environments in bigger cities. So from that standpoint, them saving early is one aspect. But also, I think the rate of expenditure will grow faster than their ability to earn through investments. That's the big danger for the generation. Because and over and above that, if they don't believe in hard assets, like real estate, for instance, it's easier to liquidate a financial investment than it is to liquidate real estate, right? Because there are different attachments to it. You live there. There is a utility. With financial investments, there isn't any other utility other than having the ability to provide for the future. So that's something to keep an eye out for, in my opinion.
Yeah, so I think there are like two ways of looking at the Gen Z as well. Now, coming to like some hard tips and, tips or advice, however you want to look at it, as a fund manager, how would you position a portfolio in 2025? We are looking at like all these economic shifts, tariffs, market corrections. You as a PMS strategy as well, you have a lot of focus on momentum and growth. But in terms of positioning, like your main advice?
So, I mean, if you're looking at 2025, it might just be that you may be better off with a fixed deposit than with equities. Because it's relatively a short period, right? But if you're looking at 2035, now I can think of more things for you, and we are doing this. We have two portfolios, Momentum and Surge India. Surge India is basically a domestic facing portfolio where we're saying we want to buy companies that are building for India in India, whether it is industrials, defense, railways, companies that are building the know-how that we would otherwise import. But because now all these trade barriers that are being set up by other countries, and we've also set them up, we're probably going to give impetus to this. And tomorrow we will find the next set of great manufacturing companies, domestic consumption. Like you said, India is traveling more, using experiences. There'll be a lot more of these companies that will list. So I think those are the spaces that I would like to do. Momentum is an algorithmic strategy that has only one virtue. You chase the price. If it's going up, you buy it. If it's not going up, you sell it. And over a long period of time, this particular strategy, if you test it backwards, it has done remarkably well for a portfolio that just buys high and tries to sell higher. So I think that is a discipline-based strategy. You have to have guts of steel and live through bad times like the time is today, turmoil and all that. But it takes a different kind of person to be able to accept that as their risk. But the reward has been demonstrably there. So I'd say two different approaches to portfolios. I like the concept of a Surge India because I think there's a lot of money to be made.
Yeah.
However, I'll say it's personal. You're a low risk taker, take an FD. High risk taker who can understand and absorb trading as a business, do trading. These portfolios are just particulars that make sense for some people because I'm selling you a story. We're all salesmen in the end, right? So we're all bringing you our side of the story. It's up to you to decide which one you'll take, and you're more empowered today to make those decisions because of the internet, because of AI than ever before. So we're going to present to you what we like, and then you'll have to make those decisions.
You have to take that call. And you've also, getting an AMC license soon. So from that standpoint as well, in terms of the larger, say, themes, sectors, what are you looking at in terms of how it will play out, say from a medium to short term and long term?
So I think the biggest drawback of investing in India has been it's primarily been talked to us like a Warren Buffett style. Look at companies, high value, long term, meet management. But there's a lot of value in just looking at the data. And looking at the data and making the informed analysis and the discipline around investing has a lot more to do with returns than the individual stocks that we highlight. Oh, I bought this stock, it went 5x. And if I buy enough number of stocks, the enough number of them will be 5x. we found at one point that 25% of India did a 5x plus return in a 10-year period. So chances are 1/4, 1 out of 4, you would have been able to show off. But it's not about being able to show off. It's about a portfolio return. So you essentially have to draw this out into something that says, I have a strategy for discipline. And we want to inculcate that as a habit, saying we'll invest quantitatively in some of our portfolios, and the other part will have data-based analysis, but maybe married with the fundamental research that one goes. And that's where we want to focus in on the equity part of the business.
Okay.
But there's a whole host on the fixed income part of the business, which I'm sure Saurabh is more aware of, because as much as if I buy a fixed deposit, I am taxed. If I am a relatively higher earner, more than 12, 25 lakhs, I'm taxed. A mutual fund which invests in the same fixed income is not. So you could hold a mutual fund for 5 years and be taxed only at the end when you get out. Versus if an FD you're taxed every year. So there's some tax advantages of having a mutual fund. To combine this with the equity part of the product and maybe the balanced, which will be a combination of both, I think we can give very interesting products for people to be able to save for their long term, specifically with the aim of saying, listen, somebody else take care of my investing. I want to take care of my life.
Yeah. And, you spoke of the India growth story as well. And that also brings me to government bonds and corporate bonds as well, for say 2025 and a little longer as we go, because you're launching bonds, right? Like, what are you seeing there? Because the bond market in India is not that deep either. A lot of people know about government bonds, not so much about corporate bonds, but what are the market dynamics there?
I think what we have seen in the wealth businesses, especially the wealth tech businesses, the seamless movement from one product to other product happen when you go from a lower return, lower risk product to a higher return, higher risk product, right? There are a lot of companies that we have seen started with a mutual fund, got into equities and then FNOs. That's the natural trajectory. It's a low cost way of scaling it up. And with that perspective, so far, I think in last 3, 4, 5 years, whoever got into the bond market has been always chasing the customers from the equity and the mutual fund market to come and invest some part of their investments into bond market. But I think they have always been looking for a higher return. A natural transition that we believe would happen from customers who've been doing fixed deposit, where that incremental 2 to 3% extra return with some risk is a more likable option where the maximum transition would happen. And we genuinely strongly believe that a large part of retail getting into the bond market would come from these conservative investors slowly getting to those bonds, where government bonds, T-bills, G-Secs, all of these things are very good entry points to get in, because that comes with a high relevance, super safety, things that they know that they can trust, and plus so much of regulators pushing digitization happening. I think that has become easier as well. Almost 85% of my customers who are buying bonds today have heard and seen the bonds for the first time. And they have been through their life, mostly the FD customers or some part of SIP that they do in mutual fund. And then getting into a AA, AAA rated bonds looking for 11 and 12% return is very encouraging. Now, how long or how seamlessly this story will flow over the next couple of couple of years is what we have to see.
If you can just explain briefly about how the bonds work, right? Because I mean, it's a loan that the government or a corporate is taking from an individual. But when you talk about yields and how it plays out in, say, a volatile market like this, where we are likely to see RBI level interest rates going
and that's
down.
what we were also discussing, that translating that into a real-time yields and interest rate is very tricky for the retail investors. And what we are seeing is, for us, if you hold that bond till maturity, you know this is the exact return that you will get. And that's been the story for us, saying that you look for a 12% return, YTM, this is what exactly that you will get after the 12th month on the maturity. Now, in between, the prices will fluctuate, but the kind of investors that we have are not doing it or coming it here to maximize their value. They're doing it for the fixed income, so that they invest here and forget and do something else that they want.
So there is a little bit of risk involved, but you look
Yes.
at it from a fixed income sort of standpoint. Yeah, got it. Then to wrap it up and rapid fire, really, the biggest money myth that you have heard.
Money doesn't buy happiness. It buys happiness for the first X years of your life. After you have too much of it, then it doesn't buy happiness.
Money solve your money problem.
Yeah, money is also very good.
And when you have it, then you can see
Yeah,
that.
I mean, all of us give gyan. No, it doesn't buy happiness because we have enough of it. So,
But I think FIRE is one thing that is a myth for me. I think it doesn't make any sense.
The top 3 criteria when picking stocks.
Top criteria,
Yeah.
competitive advantage. A company's ability to create a competitive advantage to survive. Because that I feel, and a survival instinct is what I see, what I seek. And there are multiple ways to try and identify that. What appear to be like accolades and victories could actually be eligibility criteria for companies to survive the next cycle and the one after that.
Yeah. Saurabh, how?
I think management is one thing that have been very, and I've clearly seen a couple of like food delivery companies, right? One is it's similar businesses, but how management plays it very differently, and where the companies are valued very differently.
So I like price momentum. So my prices are going up. I like strong growth. So that means this company has a scale to grow to. It's not limited. The third one is a hungry management. So if the management isn't hungry to grow, you're going to not get great returns.
And the one financial trend or asset class that excites you the most?
Domestic consumption. I think we are under indexed on that. There are not enough bowling alleys in India to meet all the bowling alley requirements. And that I could replace bowling alley with hundreds of things that we all want to do, but there's too little of to do. So I think domestic consumption is a huge thing that is going to happen to us.
We have lots of pickleball and paddleball courts. Don't know.
Apparently, that's the new thing that's being invested in, but they're not listed, sadly.
To me, I think it is mutual fund sahi hai. Not because I believe in it, but because it's the undercurrent of our rising markets. Let's just say.
Is the most predictable way to...
No, not
for
just
wealth
that, it has
creation, I
saved
suppose?
us. I think mutual fund sahi hai. The fact that people believe it and they're investing in it has saved us. Because otherwise stocks wouldn't be at this level. There would be a lot of value deterioration because FIIs have been selling, right? Somebody had to absorb it.
Investors are like holding on and...
SIP inflows have saved the Indian equity markets in my opinion.
Like suddenly IPL ads have changed from mutual fund sahi hai to now stay put, stay invested, hota rehta hai.
Tendulkar saying, "Mera bhi paisa gaya."
It's not something to be overconfident about, but I feel like while we appreciate SIP investing and mutual fund sahi hai, we need to encourage it also as a system, right? That we don't, and the best way to do that is incentivized by lowering taxes. Like Indian investors are being taxed a lot. Right? Every time there's a chance, either the STT goes up, or the LTCG goes up, or the STCG is hiked. So we need to encourage investors, not just appreciate them. And I truly believe that.
And what have markets taught you about life and life taught you about markets?
कि कुछ भी हो सकता है.
I think for me, not putting all your eggs in one basket. Like my dad was a stockbroker, and it becomes very, very difficult when things are not right, when your all eggs are in one basket. So it's...
Mine is, I think, don't predict, respond. We say this a lot. I can't predict for the life of me, and it's better to let things happen and respond to them. And that's my life learning as well. Let things happen to you and then figure out what to do next. Because if you start thinking of all the things that can happen to you, you will waste your life in the tomorrow and not live in the present.
And okay, so last question before we wrap it up. What differentiates people who are wealthy from people who are not, in terms of, what are the skills that people can inculcate as well to develop that mindset?
I was about to say the difference is mindset.
Mindset, okay.
Yes.
That's okay.
Yeah, the difference is mindset.
So my thing is learn to fail. We live too much of our lives not having failed for the first maybe 15 or 16 years of our lives, passing all our exams. We should just learn to fail more. And if you learn to fail, you'll improve and you'll do things. We just don't embrace and are happy with failures. Instead, we feel miserable about failure. Then you change the mindset to, I will try and I will fail. And if you try, great things will happen.
I think the difference between wealthy and the rich or not so rich is mainly diversification. More diversification leads to less wealth. Less diversification can lead to more wealth. It's always concentration that adds the maximum amount of wealth, which is why the richest people in the world are business people. Right? The wealth comes from their equity. And so they're not so diversified, are they? Like 99% of their net worth, if not 90% of their net worth, is probably in one stock.
But when you look at it from a retail investor perspective, right? I mean, like not everybody is building a business. So
Right.
like,
But the principles still hold true. The more diversified you are, the less money you are likely to make over the long term. Of course, I'm not saying that concentration will make you wealth. You'll have to, this is selection bias. At the end of the day, you'll have to pick the winners. But when you pick the winners, even if you look at Rakesh Jindwala or look at Warren Buffett, or if you look at any successful investor, much of their wealth was made in very, very few investments.
yeah. Got it. Saurabh?
Yeah, I think for me, try not to copy others. It's a very single player game, and figure out your own way of doing things. I've seen a lot of time, like myself, making that mistake of copying somebody else's investments or thesis or life. I think that doesn't help much. I think until the time I figure out, oh, this is how I operate, this is how my mindset is, I think that's the best way to do that.
Great. Thank you so much, all three of you, for your time and, of course, sharing your insight perspective on how to really, play out the market volatility that we're seeing. Thank you so much for joining us, and do, of course, stay tuned for the next episode.